Alright, before we dive in, let's get the important stuff out of the way. I am not a licensed financial advisor or an insurance agent. This presentation is for informational and educational purposes only, based on extensive research and experience. Your financial situation is unique, so please use this video as a starting point and always consult with a qualified, licensed professional before making any binding decisions. Okay, legal stuff done. Let's talk about your first car. I remember mine, a 10-year-old Toyota Corolla Silver, with a cassette player and a dent in the passenger door that I swore gave it character. I saved for 2 years for that car. The feeling of getting those keys, it was pure freedom. I drove it off the lot, grinning like an idiot, feeling like I had finally made it. And then, about a week later, the first insurance bill arrived. And my heart sank. It was almost half my car payment. I was paying a fortune for a policy I didn't even understand. And right there, I made the single biggest financial mistake you can make with your first car. It wasn't buying the wrong car. It was buying the wrong insurance. It's a mistake that costs young drivers in the United States billions of dollars every single year. And it's a trap set so perfectly, you barely even see it until the bill arrives. Today we are going to dismantle that trap. This isn't just another boring video about insurance definitions. This is a masterclass, a step-by-step playbook designed to do one thing: turn you from an easy target into a savvy consumer who can navigate the confusing world of auto insurance and walk away with the perfect policy at the best possible price. By the time this video is over, you will understand the system better than 99% of other first-time car buyers. You'll know what coverage you absolutely need, what's a complete waste of money, and how to spot the tricks and tactics companies use to get you to overpay. You'll have a clear-cut strategy that could save you hundreds, maybe even thousands, of dollars over the life of your first car. So why is this so hard? Why does getting insurance feel like you're trying to read a foreign language while a salesman is breathing down your neck? It's because the entire system is, by design, stacked against you as a new driver. First, you're automatically labeled high risk. To an insurance company, your new driver's license is basically a giant warning sign. They don't see you, they see a statistic, a probability of an accident. They haven't seen your driving record yet, so they assume the worst and charge you the most. Second, you're hit with an avalanche of information. You've got liability, collision, comprehensive, uninsured motorist, PIP, MedPay. It's a sea of jargon designed to overwhelm you. When you're confused, you're more likely to just say yes to whatever the agent or the online form suggests, which is almost always more than you actually need. And the biggest trap of all? The one that feels like a safe, cheap option but can financially ruin you? It's called state minimum coverage. Every state in the US has a minimum amount of insurance you're legally required to carry to drive a car. And when you're trying to save money, opting for the legal minimum sounds like a smart move. It is, without a doubt, the most dangerous financial gamble you can take. We are going to blow the lid off why that is in just a minute. To make sense of all this, we need a framework. A simple way to think about it. I call it the 3 pillars of smart insurance. Pillar 1 is understanding the core coverages, what they are, what they do, and how much you really need. Pillar 2 is mastering the art of the quote. This is where we learn how to shop around like a pro and make insurance companies compete for your business. And Pillar 3 is unlocking the hidden discounts, the secret savings that most people don't even know exist. Today we're starting with the absolute foundation, Pillar 1, the core coverages. And the most important one of all is liability. If you remember nothing else from this video, remember this: liability coverage is not for you. It's for the other guy. It's your "I'm sorry I messed up" fund. When you cause an accident, liability insurance pays for the damage you do to other people and their property. It doesn't pay a single penny to fix your car or to cover your medical bills. This is solely about covering the financial damage you inflict on someone else. And it's broken down into 2 critical parts: bodily injury liability and property damage liability. Let's start with bodily injury. This covers the medical expenses, lost wages, and pain and suffering of the people you injure in an at-fault accident. Now look at a potential insurance quote. You'll see some numbers that look like a fraction, something like 25/50. This isn't complicated. The first number, the 25, stands for $25,000. That's the maximum amount your insurance will pay for a single person's injuries in an accident you cause. The second number, the 50, stands for $50,000. That's the maximum total amount your insurance will pay for all injuries combined in that same accident. So if you hit a car with 3 people in it, your policy will pay out a maximum of $50,000 for their medical bills, with no single person getting more than $25,000. Now let's talk about property damage. This is the third number you'll often see. So a policy might be listed as 25/50/25. That last 25 stands for $25,000. That is the maximum amount your policy will pay to repair or replace the property you damaged. This is mostly the other person's car, but it could also be a mailbox, a storefront, a fence, or a prized collection of garden gnomes. Whatever you hit, that's the pool of money available to fix it. Now let's connect this back to that dangerous state minimum trap. Many states have minimum liability limits set at something like 25/50/25 or even lower. And you might think, $25,000 sounds like a lot of money to fix a car. But let's play this out in the real world. You're driving on a rainy day, you look down at your phone for just 1 second, and you rear-end the car in front of you. It's a brand new Ford F-150. The average price of a new F-150 is over $50,000. That $25,000 in property damage coverage you have, it's gone in an instant, and you are now personally on the hook for the remaining $25,000 to replace that truck. But it gets worse. Let's say the driver of that truck gets whiplash and has to go to the emergency room. An ER visit, an MRI, and a few weeks of physical therapy can easily blast past your $25,000 bodily injury limit. Let's say their bills total $40,000. Your insurance pays the first $25,000. Who pays the other $15,000? You do. So from 1 second of distraction in a very common type of accident, you are now personally facing a bill for $40,000. That's a debt that can follow you for years. They can sue you for it. They can garnish your wages, meaning they can take money directly out of your paycheck every single week until it's paid off. Your dream of saving for a house, traveling, or investing in your future, it just got put on hold for the next decade, all because you tried to save maybe $20 or $30 a month by choosing the state minimum. This is not a risk worth taking. Your first car should be a ticket to freedom, not a path to financial ruin. So, what is the right amount of liability coverage? That's exactly what we're going to break down next. To figure this out, let's move away from abstract numbers for a second and talk about a real-world scenario. Let's imagine a new driver, we'll call him Alex. Alex just got his first car, a used but reliable sedan. He's excited, he's tasting that freedom, and he wants to save money. So when he buys his insurance, he tells the agent, just give me the cheapest legal option. In his state, that's 25/50/25. He thinks he's being smart, saving about $40 a month. A few weeks later, Alex is driving home from a friend's house. It's raining, the roads are slick. He's a little distracted, maybe changing the song on his phone, and he doesn't see the traffic ahead stop as quickly as it does. He slams on the brakes, but it's too late. He rear-ends a brand new SUV. It's not a high-speed crash, but the impact is significant. The airbags in his car deploy. The SUV has a crumpled bumper and a shattered rear window. The driver of the SUV, a woman named Sarah, and her passenger both complain of neck and back pain. An ambulance is called. Everyone is shaken up, but thankfully, it seems like there are no life-threatening injuries. The police arrive, a report is filed, and Alex is found at fault. This is where his decision to buy the cheapest insurance possible begins to unravel his entire life. Let's break down those numbers on his policy. 25/50/25. This is the bedrock of your insurance policy, your liability coverage. It doesn't cover you or your car at all. It covers the damage you do to other people and their property. The first number, the 25, stands for $25,000. This is the maximum amount his insurance company will pay for bodily injury to a single person in an accident he causes. Sarah, the driver of the SUV, gets checked out at the hospital. She has severe whiplash and a herniated disc. Her initial hospital visit, MRI, and follow-up appointments with a specialist quickly add up. Her medical bills climb to $35,000. Alex's insurance pays the first $25,000. What about the other $10,000? That doesn't just disappear. Sarah's lawyers send a letter directly to Alex. He is personally on the hook for that $10,000. The second number, the 50, stands for $50,000. This is the maximum amount the insurance company will pay for bodily injury for the entire accident, no matter how many people are hurt. Remember, Sarah had a passenger. His injuries were less severe, but his medical bills still came out to $20,000. So the total medical bills for the accident are $35,000 for Sarah, plus $20,000 for her passenger. That's a grand total of $55,000. Alex's policy has a $50,000 limit for everyone combined. So the insurance company pays out its max of $50,000. That still leaves $5,000 in medical bills unpaid. And guess who is responsible for that? Alex. He now owes $10,000 for Sarah's overage, plus the remaining $5,000 for the total accident overage. He is now $15,000 in debt from medical bills alone. And we haven't even talked about the car yet. The third number, the other 25, stands for $25,000. This is the maximum amount his insurance will pay for property damage. This means the other person's car, but it could also mean a mailbox, a storefront, a city guardrail, anything Alex hits and damages. Sarah's brand new SUV has significant damage. The repair estimate comes back from the body shop, $32,000. It's a new vehicle with complex sensors in the bumper and a high-end paint job. Alex's policy covers property damage up to $25,000. The insurance company writes a check for $25,000. That leaves a $7,000 gap. Sarah's insurance company pays to fix her car, and then their legal team comes after Alex for that $7,000. So let's do the math. Alex is personally responsible for $10,000 of Sarah's medical bills, $5,000 for the total accident overage, and $7,000 for the damage to her car. That's a total of $22,000. Alex, a young person with his first job, doesn't have $22,000 sitting in the bank. So what happens? He gets sued. The court issues a judgment against him. His wages can be garnished, meaning they take a chunk of his paycheck every single week until the debt is paid. Any assets he has or might inherit in the future could be at risk. That $40 a month he saved has now cost him his financial future. All because of one rainy Tuesday and a bad decision. This story isn't an exaggeration. It happens every single day. The average new car in America costs over $45,000. A moderate car accident can easily result in medical bills exceeding $25,000 per person. State minimums are a financial trap, set by state legislatures decades ago, and rarely updated to reflect the modern cost of cars and healthcare. They exist only to make driving technically legal, not to actually protect you. So what is the right amount? The answer is, as much as you can reasonably afford, but there's a smart baseline that most financial experts recommend. Instead of 25/50/25, look for a policy with at least 100/300/100. Let's see how Alex's story would have changed with this coverage. 100. $100,000 for a single person's injuries. Sarah's $35,000 medical bill would have been completely covered. 300. $300,000 for total injuries in the accident. The total $55,000 in medical bills would have been completely covered. 100. $100,000 for property damage. The $32,000 repair bill for Sarah's SUV would have been completely covered. With this 100/300/100 policy, Alex would have owed $0. He would have filled out some paperwork, spoken to his agent, and moved on with his life, having learned a valuable lesson about distracted driving. His insurance would have done its job. The financial devastation would be completely gone. Now you're probably thinking, that sounds great, but coverage that's 4 times higher must be 4 times more expensive. And this is the most important secret of the insurance industry. It's not. The jump in price from a terrible state minimum policy to a solid protective 100/300/100 policy is surprisingly small. Why? Because the biggest risk for an insurance company is you having an accident at all. The administrative cost of managing your policy is a big chunk of the price. Once you're paying for a basic policy, the cost to add more coverage, to go from $25K to $100K, is incremental. You might be looking at an extra $20, $30, maybe $40 a month. It is the single best value you can get. You are trading a few extra dollars for hundreds of thousands of dollars in protection. So, the bare minimum you should even consider is 100/300/100. But the truly correct answer is tied to your personal financial situation. The rule of thumb is this: your liability coverage should, at a minimum, equal your net worth. Your net worth is everything you own, your savings, your investments, the equity in your home if you have one, minus everything you owe. If you have a $50,000 savings account and no debt, your net worth is $50,000. If you get sued for more than your insurance covers, they can go after your assets. So, if your net worth is $150,000, you should be looking at liability limits of at least $250/500/100 to make sure your life savings are protected. For most first-time car buyers, you might not have a huge net worth yet. which is why 100/300/100 is such a strong starting point. It protects your future ability to build that net worth. Don't let an agent talk you down to the state minimum to save you money. You're not saving money. You're just taking on a massive, uncalculated risk. You are essentially self-insuring for catastrophic loss, and that is a gamble you cannot afford to lose. Choosing robust liability coverage is the single most important decision you will make. It protects your future, your freedom, and your peace of mind. But liability only covers the damage you do to others. In our story, Alex's own car was also wrecked. If he still owed money on a car loan, he'd still have to make those payments every month, even on a car that's now a pile of scrap metal in a tow yard. Liability coverage would not pay one single dime to repair or replace his car. For that, you need two entirely different types of coverage. They are what protect your investment in the car itself, and one of them even covers you for things that aren't your fault at all, like theft, hail damage, or a tree falling on your car in the middle of the night. That's what we're digging into next. These two coverages are called collision and comprehensive, and they sound similar, but they protect you from completely different kinds of disaster. Let's break it down, starting with the one that's easier to understand: collision coverage. Collision is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, of course, but it could also be a telephone pole, a guardrail, a fire hydrant, or even the wall of your own garage. It also covers damage from your car rolling over. The single most important thing to understand about collision coverage is that it pays out regardless of who is at fault. Let me say that again because this is huge. Pays out regardless of who is at fault. If someone runs a red light and plows into you, their liability insurance should cover your car. But what if they don't have enough insurance? What if it's a complicated he said she said situation that takes months to sort out? Or what if the accident is, well, your fault? Imagine you're driving home late one night. It's raining, the roads are slick. You take a turn a little too fast, you hydroplane, and you slam right into a concrete median. Nobody else is involved. It's just you, your car, and a very expensive-looking concrete barrier. Your car is a mess. The front end is crumpled. Without collision coverage, you are on your own. You're paying for that tow truck, and you're paying for every single dollar of those repairs out of your own pocket. Or more likely, you're pricing out used cars on your phone from the side of the road because yours is now a total loss. But with collision coverage, you can breathe a little easier. You call your insurance company, they assess the damage, and they cut you a check to get your car fixed or replaced. Now, it's not a blank check. This is where a critical concept comes into play: the deductible. Your deductible is the amount of money you have to pay out of pocket for a claim before your insurance company starts paying. Think of it as your share of the repair cost. Deductibles for collision coverage typically range from $250 to $1,000, or even more. The most common is $500. Let's go back to that rainy night. The body shop estimates the repairs will cost $7,000. If you have a $500 deductible, you pay the first $500. Your insurance company then pays the remaining $6,500. If the damage was only $400, you'd pay for it all yourself because the cost is less than your deductible. You wouldn't even file a claim. This brings up a crucial decision you have to make when you buy your policy. What deductible should you choose? And here's the trade-off. A lower deductible, say $250, means you'll pay less out of pocket if you have an accident. But it also means you'll pay a higher premium every month. A higher deductible, like $1,000, means you'll have a lower monthly premium, but you'll have to come up with more cash if you get in a wreck. So what's the right choice for a first-time car owner? The golden rule is this: choose the highest deductible you can comfortably afford to pay on a moment's notice. Don't pick a $1,000 deductible to save $30 a month if you don't have $1,000 sitting in an emergency fund. Because accidents don't make appointments. They happen instantly, and you'll need that deductible money right away. For most new drivers, a $500 deductible is a very common and solid starting point. Okay, so that's collision. Covers you when you hit something. But what about all the other bad things that can happen to your car that have nothing to do with a crash? What if you park your car overnight and a massive branch from an old oak tree snaps and crushes your roof? What if a hailstorm rolls through and makes your car look like a golf ball? What if you're driving down a country road at dusk and a deer decides to leap in front of you? These are not collisions in the traditional sense. And this is where the second hero of our story comes in: comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It covers damage to your car from just about everything else. This is the coverage for the weird, the random, the acts of God, and the acts of criminals. It covers theft. If your car is stolen, comprehensive coverage will pay you for its value. It covers vandalism. Someone keys your car, smashes a window, or slashes your tires. That's comprehensive. It covers fire, floods, earthquakes, and windstorms. It covers riots and civil commotion. It covers falling objects like that tree branch or hail. And yes, it covers hitting an animal like that deer. Just like collision, comprehensive coverage also has a deductible. The principle is exactly the same. If a deer runs out and causes $3,000 in damage, and you have a $500 comprehensive deductible, you pay $500, and your insurance pays $2,500. You typically choose your collision and comprehensive deductibles at the same time, and they can be the same amount or different. So now the big question. Liability coverage is required by law. But are collision and comprehensive? The answer is, it depends. Legally, if you own your car free and clear, meaning you paid cash for it or you've completely paid off your loan, then no state requires you to have collision or comprehensive. You are legally allowed to take that risk yourself. However, and this is a massive however, for almost every first-time car buyer. If you have a loan on your car, or if you are leasing it, your lender or leasing company will almost certainly require you to have both collision and comprehensive coverage. And they'll probably specify the maximum deductible you're allowed to have, usually $500 or $1,000. Why? Because until you pay off that loan, the bank or finance company is the legal owner of that car. It's their asset. They have a financial interest in making sure that car is protected from damage or theft. They don't want you to crash a $15,000 car that they financed, be unable to fix it, and then just stop making payments. By forcing you to have full coverage, they are protecting their investment. But let's say you bought an older, used car with cash. You own it outright. The decision is now yours. Should you pay the extra money for collision and comprehensive? To answer this, you need to ask yourself one simple, brutally honest question. If my car was destroyed tomorrow, could I afford to repair or replace it without causing a major financial crisis in my life? If your car is worth $10,000 and you have $200 in your savings account, the answer is a resounding no. You absolutely need the coverage. The extra cost per month is your peace of mind payment. It's the safety net that prevents a single bad moment from turning into a year of financial hardship. But what if your car is a 20-year-old beater that you bought for $2,000? And let's say adding collision and comprehensive would cost you an extra $600 a year. In 3 years, you'll have paid $1,800 in premiums just for that coverage, nearly the entire value of the car. In this case, it might make more financial sense to self-insure. That means you skip the coverage, but you take that $600 a year and put it into a dedicated savings account for car repairs or replacement. If the car gets totaled, you won't get an insurance check, but you'll have a growing pile of cash ready to help you buy your next one. A general rule of thumb many people use is the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's cash value, you should seriously consider dropping it, assuming you own the car outright. So for that $2,000 car, 10% is $200. Since the coverage costs $600 a year, it's probably not worth it. For the $10,000 car, 10% is $1,000. If the coverage costs less than that, it's likely a good investment. So we've now protected other people with liability, and we've protected our own car with collision and comprehensive. We've covered the assets. But what about the single most important thing involved in any car journey? The people. Specifically, you and your passengers. What happens if you get hurt in an accident? Who pays for the ambulance, the emergency room, the physical therapy? And what happens if the person who hits you is breaking the law and driving with no insurance at all? Now you're injured, your car is wrecked, and the person responsible has no way to pay for any of it. That is a terrifyingly common scenario, and it's exactly why the next set of coverages we're going to discuss might be the most important ones on your entire policy. Let's start with uninsured motorist coverage, or UM. This is your financial bodyguard. It steps in and pays for your injuries and, in some cases, your car's damages when you're hit by a driver who has zero insurance. And let's not forget its equally important twin, underinsured motorist coverage, or UIM. This one protects you when the at-fault driver does have insurance, but their policy limits are so low they can't even begin to cover the cost of your medical bills. Together, UM and UIM are the shield that protects you from the financial irresponsibility of others. First, let's break down uninsured motorist coverage. Typically comes in two parts. The first is uninsured motorist bodily injury, or UMBI. Think of this as a ghost policy. When an uninsured driver hits you, your own insurance company activates your UMBI coverage and essentially pretends to be the other driver's insurance company. It pays for your medical bills, your lost wages if you can't work, and even for things like pain and suffering. Without this, you're left to sue a person who already proved they can't afford insurance. Good luck collecting a dime. With UMBI, you have a safety net. Your financial future isn't destroyed because someone else broke the law. Imagine this. You're driving to a job interview for your dream position. You're stopped at a red light when suddenly, bam, you're rear-ended. The other driver speeds off. It's a classic hit and run. In the eyes of your insurance company, a hit and run is treated exactly like being hit by an uninsured driver. Your neck is in searing pain, your car is a mess, and you miss the interview. A trip to the emergency room reveals you have whiplash and will need weeks of physical therapy. Your medical bills start piling up. Who pays for this? If you have UMBI, your own insurance company does. They cover the ER visit, the physical therapy, and can even help compensate you for the wages you lose while you recover. If you don't have it, that entire financial nightmare lands squarely on your shoulders. The second part is uninsured motorist property damage, or UMPD. This, as the name implies, covers the damage to your car. Now you might be thinking, wait, doesn't collision coverage do that? Yes, it does. But here's the key difference. UMPD often has a much lower deductible than collision coverage. In some states, it might be just a couple $100s or even zero. So if an uninsured driver totals your first car, using your UMPD means you'll pay a lot less out of pocket to get it fixed or replaced than you would using your collision coverage. It's a small detail that can save you $1,000 when you're already stressed out. Now let's talk about the silent killer, underinsured motorist coverage. This might be even more important because the scenario is so much more common. Millions of drivers on the road are only carrying the absolute bare minimum insurance required by their state. And let me tell you, state minimums are terrifyingly low. Some states only require $25,000 in bodily injury liability per person. $25,000. That might sound like a lot of money, but in the world of American healthcare, it's a drop in the bucket. One ambulance ride, one MRI, and one night in the hospital can burn through that $25,000 before you're even discharged. What if you need surgery? What if you need months of rehabilitation? What if you're permanently injured and can't work the same job ever again? Let's run the numbers. Say you're in a serious accident that wasn't your fault. Your total medical bills come to $125,000. The driver who hit you has a state minimum policy of $25,000. Their insurance company will write you a check for $25,000 and that's it. They have fulfilled their legal obligation. You are now personally responsible for the remaining $100,000. Your health insurance might cover some of it, but you could still be on the hook for tens of thousands in deductibles, co-pays, and out-of-network charges. This is the exact situation that forces people into bankruptcy. This is where underinsured motorist bodily injury, or UIMBI, saves the day. If you have a UIMBI limit of, say, $100,000, your policy will step in to cover that gap. The other driver's insurance pays its $25,000 max, and then your UMBI coverage can pay up to an additional $100,000 to cover the rest of your medical bills. It transforms a life-ruining event into a manageable one. So, how much UM/UIM coverage should you get? Here is the single most important piece of advice I can give you on this topic: match your uninsured and underinsured motorist limits to your own bodily injury liability limits. Think about it. In the last video, we talked about choosing liability limits. Let's say you chose $100,000 per person and $300,000 per accident. You made that decision because you decided that's how much protection you need to safeguard your own assets if you cause an accident and injure someone else. You are protecting yourself from their potential lawsuit. So my question to you is this. If you believe someone else's injuries could be worth $100,000, why would you believe your own are worth any less? Why would you give yourself less protection than you give to a total stranger? Matching your limits is an act of valuing your own health and financial security, just as much as you value protecting your assets. It's the only logical choice. Now I know what you're thinking. More coverage means more cost. And yes, it does. But the increase in your premium for robust UM/UIM coverage is often shockingly small for the monumental level of protection it provides. We're talking about maybe a few extra dollars a month. It is, without a doubt, the single best bargain in all of auto insurance. Skipping this to save the price of a coffee or two a month is like building a house and leaving off the roof to save money on shingles. So far, we've focused on what happens when someone else is at fault. But car accidents aren't always that clear-cut. Sometimes fault is disputed for months. Sometimes it's a single car accident on an icy road. And sometimes you or your passengers are injured regardless of who is to blame. In those moments, you don't want to wait for lawyers and insurance adjusters to fight it out. You need your medical bills paid now. This brings us to our next critical layer of protection: medical payments coverage, often called MedPay, and its more comprehensive sibling, personal injury protection, or PIP. Which one you can get depends on what state you live in. A dozen or so states are known as no-fault states. In these states, it doesn't matter who caused the accident, at least for initial injuries. Your own car insurance is the primary payer for your medical expenses, up to a certain limit. This system is designed to speed up the payment process and keep smaller injury claims out of the courts. If you live in a no-fault state like Florida, Michigan, or New York, you'll be required to carry personal injury protection, or PIP. PIP is incredible. It not only covers medical bills for you and anyone in your car, but it often goes much further. It can also cover a portion of your lost wages if you can't work. It can even pay for essential services, like hiring someone to clean your house or take care of your kids if your injuries prevent you from doing so. It is a broad, powerful coverage designed to get your life back on track as quickly as possible after a crash, without the finger pointing. If you don't live in a no-fault state, you'll likely have the option to buy medical payments coverage or MedPay. MedPay is simpler than PIP. It's not usually required, but it is highly recommended. It covers medical and funeral expenses for you and your passengers up to a set limit, typically ranging from $1,000 to $10,000, or even more. Like PIP, it pays out regardless of who was at fault. Why would you need MedPay if you have health insurance? Great question. First, many health insurance plans have high deductibles and copays. MedPay can be used to pay those out-of-pocket costs. Second, unlike health insurance, MedPay covers your passengers, whether they're family or friends. It's a gracious way to ensure your friends' medical bills are taken care of if they're hurt while riding with you. Finally, if you or a passenger don't have health insurance, MedPay becomes an absolutely essential financial lifeline. It's an inexpensive add-on that provides immediate peace of mind, ensuring that the cost of an ambulance ride or an emergency room visit is covered, no questions asked. We've now built a powerful shield. A shield to protect you from the millions of uninsured and underinsured drivers on the road, and a safety net to cover your own medical bills, no matter who's at fault. We've protected you, the driver, but we've barely touched on the second most expensive thing you probably own, the car itself. What happens when your brand new ride gets sideswiped in a parking lot, stolen from your driveway, or crushed by a falling tree branch in a storm? That's when you need the two coverages that most people think of when they hear the term full coverage, and getting them wrong can be a $1,000 mistake. Those two coverages are called collision and comprehensive, and they are the difference between a minor inconvenience and a financial catastrophe. They have nothing to do with the other driver, the other car, or the medical bills. Their only job is to protect one thing: your car, your asset, the machine you just spent thousands of dollars on. Let's start with collision. The name is pretty straightforward, but the details are what trip people up. Collision coverage pays to repair or replace your car if it's damaged in an accident with another object. That could be another car, or it could be you backing into a pole, hitting a guardrail on an icy road, or accidentally scraping a concrete pillar in a parking garage. Here's the critical part. Collision coverage kicks in when you are at fault. Remember back when we talked about liability? That pays for the other person's car when you cause the accident. But who pays for your car? Liability won't touch it. Without collision coverage, the answer is simple: you do. Every single penny. If you total your brand new $10,000 car a week after buying it, and it was your fault, you're out $10,000. The car is gone, and if you have a loan, you still have to pay it off. It's a nightmare scenario. Collision coverage is your safety net. It says, okay, you made a mistake. We'll cover the repairs to your vehicle. Now, it's not a blank check. This is where you'll meet the single most important term for this type of coverage: the deductible. A deductible is the amount of money you have to pay out of pocket before the insurance company pays a dime. Think of it as your share of the repair bill. Deductibles typically range from $250 to $1,000, sometimes even more. Let's say you have a $500 deductible. You get into a fender bender, and the repair estimate is $3,000. You pay the first $500 directly to the body shop, and your insurance company pays the remaining $2,500. If the damage is only $400, your insurance pays nothing. You're on your own because the cost is less than your deductible. This is the fundamental trade-off of car insurance. A lower deductible, say $250, means you pay less in an emergency, but your monthly or 6-month insurance bill, your premium will be higher. A higher deductible, like $1,000, means your premium will be significantly lower. But you have to be prepared to shell out $1,000 at a moment's notice if you get into an accident. We'll come back to how to choose the right number in a minute, because it's a decision that reveals a lot about your financial health. So that's collision. It's for when your car hits something. But what about all the other bad things that can happen to a car that don't involve a crash? This is where collision's partner comes in. Comprehensive coverage. I like to call comprehensive the act of God and act of idiot coverage. It covers damage to your car from almost everything except a collision. Think about it. A hailstorm rolls through and turns your car's roof into a golf ball. A deer decides to play chicken with you on a country road at night. A massive branch from your neighbor's oak tree snaps off in a windstorm and crushes your hood. Your car gets stolen from your apartment complex. Someone smashes your window to grab your gym bag. Someone keys your door out of pure spite. None of these are collisions. None of them are your fault. But all of them can result in thousands of dollars in damage. Without comprehensive coverage, you are paying for all of it. With comprehensive, you just pay your deductible, and the insurance company handles the rest. Just like collision, you choose a deductible amount, and it works the exact same way. You can even have different deductibles for each. Maybe you want a low $500 deductible for collision because you're worried about accidents, but you're willing to risk a higher $1,000 deductible for comprehensive to save some money. Now you'll hear people, even insurance agents, bundle these two together with liability and call it full coverage. Let me be crystal clear. Full coverage is not a real insurance term. It's slang. It's a shortcut. If you walk into an agency and just say, "Give me full coverage," you might get a policy that leaves you dangerously exposed. Because full coverage doesn't specify your liability limits or your deductibles. It's just a vague way of saying you have the big three: bodily injury and property damage liability, collision, and comprehensive. So the real question is, do you actually need them? For a brand new $10,000, $20,000, or $30,000 car? The answer is an unequivocal yes. But what about an older, used car? This is where you have to do some simple math. The rule of thumb is this: if the cost of your collision and comprehensive coverage for 1 year is more than 10% of your car's actual cash value, you might want to consider dropping them. Let's say you have a 15-year-old Honda Civic that's worth about $2,000. The collision and comprehensive portion of your insurance costs you $600 per year. You have a $500 deductible. So, if you total the car, the absolute maximum your insurance company will pay you is $1,500. Is it worth paying $600 a year to protect a $1,500 payout? Probably not. You'd be better off saving that $600 in a separate bank account for car repairs or a down payment on your next car. But let's flip it. You have a 5-year-old Toyota Camry worth $15,000. The collision and comprehensive coverage costs you $800 a year with a $1,000 deductible. If you total it, the insurance company will hand you a check for $14,000. Is it worth paying $800 a year to protect a $14,000 asset? Absolutely. 100%. There is, however, one giant exception to all of this math. If you have a loan on your car or if you're leasing it, the decision is made for you. The bank or leasing company that technically owns your car will require you to carry both collision and comprehensive coverage with a specific maximum deductible, usually no more than $1,000. Why? Because it's not really your car yet. It's their asset. They are protecting their investment from you, from acts of God, from thieves, from everything. Until that loan is paid off, you have no choice in the matter. So, assuming you have the choice or you're forced to have it, how do you pick that all-important deductible? The answer is brutally honest. You need to ask yourself, how much cash can I come up with right now without going into debt or missing my rent payment? This is the emergency fund test. A $1,000 deductible is fantastic for keeping your premiums low, but it's completely useless if you don't have $1,000. If you get into an accident and the body shop needs that $1,000 before they'll even start the repairs, and you can't pay it, your car is just going to sit there, useless. You'll be paying a low premium for a benefit you can't even access. In that case, you are far better off paying a slightly higher premium for a $500 or even a $250 deductible. Choose the highest deductible you can comfortably afford to pay with cash tomorrow. If you have a healthy emergency fund of a few $1,000s, go for the higher deductible and enjoy the lower monthly bill. If you're living paycheck to paycheck, a lower deductible is your friend. It's a form of self-discipline, forcing you to pay a little more each month to protect yourself from a sudden, unaffordable expense. So, we've covered the other guy's car with your property damage liability, we've covered your own car from crashes with collision, and from everything else with comprehensive. Feels like we're protected, right? Feels like we've covered all the bases, but we've missed the most important asset in the entire equation. What about the people? What about you? What happens if you're injured in an accident? Who pays for the ambulance, the emergency room, the surgeries, the physical therapy? Who pays your rent when you can't work for 2 months because of your injuries? That's where two of the most misunderstood and critically important coverages come into play, and skipping them is a mistake that doesn't just cost you money, it can derail your entire life. Those two coverages are uninsured and underinsured motorist coverage. And if you're tuning this out right now, thinking it's just more insurance jargon, I need you to listen closer than you have for this entire video. Because understanding this part isn't about saving a few bucks, it's about saving yourself from financial ruin. Let's start with a terrifying and frankly infuriating statistic. According to the Insurance Research Council, about 1 in every 8 drivers on the road in the United States has no auto insurance. 1 in 8. Look around you the next time you're at a stoplight. See those 8 cars waiting with you? Statistically, one of them is driving illegally, with zero ability to pay for any damage they cause. They are a financial time bomb on wheels, and you have no idea which one they are. This is where uninsured motorist coverage, or UM, becomes your absolute, non-negotiable lifeline. Let's imagine you just bought your first car. A reliable, slightly used Honda Civic. You've done everything right. You saved up, you got a decent loan, and you bought a good insurance policy with the liability limits we talked about. You're a responsible driver. One afternoon you're driving through a green light in BAM. Someone blows through the red light and T-bones your driver's side door. It's a bad one. Your car is mangled and your leg is broken. The police arrive, the other driver is clearly at fault. They get the ticket. You get the ambulance. And then the police officer tells you the news that makes your stomach drop. The other driver has no insurance. They let it lapse months ago. They have no assets, no savings. They literally cannot pay. So what happens now? Your brand new Civic is totaled. You have a $30,000 hospital bill for the surgery on your leg. And you have to miss 2 months of work, meaning you have no income. Who pays for all of this? If you skipped uninsured motorist coverage to save, let's say, $15 a month, the answer is simple: you do. You pay for all of it. Your health insurance might cover some of the medical bills, but you'll still be on the hook for deductibles and copays that could run into the thousands. And what about your lost wages? What about the pain and suffering? What about the car itself? You can sue the at-fault driver, sure, but you can't get blood from a stone. Suing someone with no money is like trying to squeeze water from a rock. You'll spend thousands on a lawyer to win a judgment that you will likely never ever collect. You're left with a mountain of debt, no car, and a monthly payment for a vehicle that's now sitting in a scrapyard. This is the scenario that bankrupts people. This is how a simple car accident derails a life. Now let's rewind that exact same scenario. But this time, when you bought your policy, you paid that extra $15 a month for uninsured motorist bodily injury, or UMBI coverage. You chose a limit of $100,000 per person. The accident happens. The other driver has no insurance. But this time you don't panic. You call your own insurance company. And here's the magic. Your uninsured motorist coverage allows your own insurance company to step into the shoes of the uninsured driver. They effectively become the insurance company for the person who hit you. Your UMBI coverage will pay for your $30,000 hospital bill. It will pay for your lost wages for the 2 months you couldn't work. It will compensate you for your pain and suffering. It makes you whole again. It's a safety net that catches you when the system fails. There's also a component called uninsured motorist property damage, or UMPD, which would help pay to repair or replace your car. However, this isn't available in every state, and if you have collision coverage, which we'll talk about next, it's often redundant. The absolute critical part here is the bodily injury portion, the part that protects your body, your health, and your ability to earn a living. But wait, it gets even more complicated. What if the driver who hit you wasn't uninsured, but underinsured? This is the even sneakier cousin to the uninsured driver, and arguably even more common. Let's go back to our crash scene. The driver who ran the red light does have insurance. Phew, right? Wrong. They have the absolute bare minimum liability coverage required by their state. Let's say their state minimum for bodily injury liability is only $25,000. Remember, your medical bills and lost wages total over $50,000. The other driver's insurance company will write you a check for their policy limit, $25,000, and then they wash their hands of the situation. That's all they are legally required to pay. You are now personally on the hook for the remaining $25,000 plus. Again, you're left with a crippling debt because someone else was irresponsible. This is where underinsured motorist coverage, or UIM, saves your skin. It's often bundled together with uninsured motorist coverage. UIM is designed to cover the gap. It kicks in after the at-fault driver's insurance maxes out. So, their policy pays the first $25,000, and then your UIM policy steps in to cover the rest up to your policy limit. If you have a $100,000 UIM limit, you're covered. Your bills get paid. You can focus on recovering instead of figuring out how to declare bankruptcy. Do you see the pattern here? Both of these coverages protect you from the financial irresponsibility of other drivers. You can be the safest driver in the world, but you can't control the person texting in the lane next to you, or the person who decided paying their insurance premium was less important than buying a new TV. So what's the takeaway here? It's a simple rule. Your uninsured and underinsured motorist coverage limits should always match your own bodily injury liability limits. If you decided that you need $100,000 of liability coverage to protect other people from the damage you might cause, then you are damn well worth protecting for that same amount. Don't value a stranger's well-being more than your own. It's that simple. When you get a quote, you'll see that adding or increasing this coverage is shockingly inexpensive for the monumental level of protection it provides. We're often talking about the cost of a few cups of coffee a month to protect yourself from a six-figure catastrophe. There is no better bargain in the world of insurance. So I want you to do something. If you have a policy, pull it up. If you're looking at quotes, find the line item. Find uninsured/underinsured motorist bodily injury. What are those numbers? If you waived it or if you have the state minimum, you are exposed. You are driving with a massive hole in your financial armor. Fix it. Call your agent or go online and increase those limits to match your liability limits today. So now you're protected from other people, and you're protected from irresponsible people who don't have enough insurance. You've built a fortress around your financial life. But what about a deer jumping out on a country road? Or a freak hailstorm that turns your car into a golf ball? Or your own simple human mistake when you back into a concrete pole in a parking garage? In all of those cases, none of the coverages we've discussed will pay a single penny to fix your car. That's when the two coverages that actually fix your car come into play, and misunderstanding them can leave you with a massive loan payment on a car you can no longer even drive. These two coverages are called collision and comprehensive, and they are not optional extras. For most people with a financed car, they are the absolute bedrock of their financial security. Think of them as the armor plating for your investment. Let's start with collision coverage. The name is pretty straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, a garage door you forgot to open, you name it. If you collide with it, this is the coverage that steps in. And here is the most important phrase you need to remember. Regardless of fault. Let me repeat that. Regardless of fault. This is a game changer. Let's say you're backing out of a tight parking spot. You're new to the car. You misjudge the turning radius, and you hear that soul-crushing sound of metal scraping against a concrete pillar. Your heart sinks. The entire passenger side of your brand new to you car is now a modern art installation of scratches and dents. It's a $1,000 mistake. Maybe more. If you only have liability coverage, you're on your own. Liability pays for the damage you do to others, remember? It does absolutely nothing for the damage you did to the pillar, and it certainly does nothing for the damage to your own car. You're now faced with a horrible choice. Either drain your savings to fix the car you just bought, or drive around in a damaged vehicle that reminds you of your mistake every single day, all while you continue to make that monthly loan payment. But with collision coverage, the story is completely different. You make one phone call to your insurance company, you tell them what happened, and then you pay something called your deductible. The deductible is the amount you agree to pay out of pocket for a repair before the insurance company starts paying. Think of it as your share of the cost. Deductibles typically range from $250 to $1,000, or even more. So, in our pillar scenario, if the repair bill is $3,000 and you have a $500 deductible, you pay the first $500. Your insurance company then pays the remaining $2,500. Your car gets fixed, it looks like new, and you just avoided a multi-thousand-dollar financial disaster. And because it's regardless of fault, it also protects you in a hit and run, or if the other driver's insurance is a nightmare to deal with. Your collision coverage can step in, pay to get your car fixed immediately so you can get back on the road, and then your insurance company will go fight the other driver's company to get their money back. You get your car fixed now, not in 6 months when the lawyers are done arguing. So that's collision. Covers you when you hit something. But what about all the other bad things that can happen to a car that don't involve a crash? That's where its partner comprehensive coverage comes in. Comprehensive is sometimes called other than collision coverage, and that's the perfect way to think about it. It protects your car from virtually every other type of physical damage you can imagine. This is the coverage for the chaos of life. A freak hailstorm pummels your city, leaving your car's hood and roof looking like a golf ball. Comprehensive covers it. You're driving down a country road at dusk, and a deer leaps out in front of you. Comprehensive covers it. A thief smashes your window and steals your stereo, or worse, steals the entire car. Comprehensive. Your engine catches fire. A tree branch snaps in a windstorm and falls on your roof. Your car is damaged in a flood or vandalized by someone with a key. All of these disasters, these acts of God and acts of malice, are covered by comprehensive insurance. Just like collision, comprehensive coverage has a deductible. You choose the amount, you pay that first, and the insurance company handles the rest. It's the ultimate peace of mind. Without it, one bad storm or one unlucky encounter with a deer could instantly wipe out the value of your car, leaving you with that dreaded loan payment on a pile of scrap metal. Now you might be thinking, okay, this all sounds great, but it also sounds expensive. Do I really need both? For 99% of people buying their first car, the answer is not just yes, it's that you don't have a choice. And here's why. If you take out a loan to buy your car, or if you lease it, the lender, the bank or credit union that gave you the money, will require you to carry both collision and comprehensive coverage. Think about it from their perspective. Until you pay off that loan, that car isn't really yours. It's the bank's asset. It's the collateral they have for the $30,000 loan they gave you. They need to protect their investment. They need to know that if you total that car, their asset won't just vanish into thin air. They require you to have collision and comprehensive so that if the car is destroyed, the insurance company will pay to fix it, or if it's totaled, pay out its value. That money is then used to pay off your loan. It's non-negotiable. If you let that coverage lapse, the lender can, and often will, buy a policy for you at a ridiculously high price and tack it onto your loan payment. So, for a financed car, the decision is made for you. You need both. Together, this package of liability, collision, and comprehensive is what people in the real world casually refer to as full coverage. Now, full coverage isn't an official insurance term. You won't find it written on any policy. It's just slang for a policy that protects you from damaging others, and also protects your own car from pretty much anything that can happen to it. When you call an agent and say, "I need a quote for full coverage," this is what they're going to build for you. The real choice you have to make isn't if you should get these coverages, but how you should structure them. And that comes down to one thing: your deductible. Choosing your deductible is one of the most important financial decisions you'll make with your insurance policy. There's a simple inverse relationship at play here. The higher your deductible, the lower your monthly premium will be. The lower your deductible, the higher your premium will be. An insurance company sees a high deductible as you taking on more of the risk yourself. If you have a $1,000 deductible, you're less likely to file a small claim for an $800 bumper scuff, which saves them money, so they reward you with a lower rate. Conversely, if you have a low $250 deductible, you're more likely to file claims for minor damage, which costs them more, so they charge you a higher premium to offset that risk. So which one should you choose? The answer is based on one simple, brutally honest question. How much cash could you come up with tomorrow without it causing a major financial crisis in your life? That amount is your deductible. Don't choose a $1,000 deductible just to save $20 a month on your premium if you don't actually have $1,000 sitting in an emergency fund. That's a catastrophic mistake, because if you get into an accident, your car will be sitting in a body shop, unusable, until you can pay that deductible. If you can't pay it, you can't get your car back. You'll be stuck making a loan payment, an insurance payment, and paying for Ubers, all because you were trying to save a few dollars. A $500 deductible is the most common and often the sweet spot for many people. It's a painful but usually manageable amount to have to pay unexpectedly. If you have a robust emergency fund and want to maximize your monthly savings, a $1,000 deductible might make sense. If the thought of a $500 surprise bill gives you anxiety, a $250 deductible might be worth the higher premium for the peace of mind. You're not just buying a policy, you're creating a personal financial safety net. Collision and comprehensive are the main threads of that net, protecting the physical value of your car. But there's a hidden trap here. A financial nightmare where your car is totaled, the insurance company pays out, and you still find yourself thousands of dollars in debt with no car to show for it. It's called being underwater on your loan, and we're about to talk about the one coverage that can save you from drowning. This life-saving coverage is called gap insurance. And the name is perfect because it literally fills the gap between what your car is worth and what you still owe on it. Let's break this down with a real-world scenario, because this is where so many first-time car buyers get burned. Imagine you just bought your first brand-new car. It's beautiful. The sticker price was $28,000. You put $3,000 down and financed the other $25,000. You're driving off the lot, feeling amazing. But here's the brutal truth about new cars. The second your tires hit the public road, your car's value plummets. This is called depreciation. After 1 year, that $28,000 car might only have an actual cash value of $21,000. But your loan? You've been making payments, but a big chunk of that has been interest. You might still owe $23,000. Do you see the problem? You owe $23,000, but the car is only worth $21,000. There's a $2,000 gap. Now imagine a deer jumps out in front of you. You swerve, you hit a tree, and your brand new car is declared a total loss. Your collision coverage kicks in, and the insurance company does exactly what they're supposed to do. They cut you a check for the actual cash value of the car, $21,000. That money goes straight to your lender. But wait, you owed them $23,000. So even after the insurance payout, you still owe the bank $2,000. And the worst part? You have no car. You are literally paying for a ghost. You're writing a check every month for a pile of scrap metal in a junkyard somewhere. This is the financial nightmare gap insurance was invented to prevent. With gap coverage, after your insurance company pays the $21,000, the gap policy would kick in and pay the remaining $2,000 to the lender. Your loan is wiped clean. You're back at zero. You're not in debt for a car that doesn't exist. You're free to go out and get a new vehicle without that old debt hanging over your head. So, who absolutely needs gap insurance? Listen closely. If you put less than 20% down on your car loan, you probably need it. If your loan term is 60 months or longer, you probably need it. If you're buying a model that depreciates quickly, and many new cars do, you probably need it. And if you rolled negative equity, meaning leftover debt from your previous car, into your new loan, you absolutely 100% need gap insurance. Now for the $1 million tip, or at least the $1,000 tip. When you buy a car from a dealership, the finance manager will almost always try to sell you gap insurance. They'll roll it into your loan and it might seem convenient. Do not do it. Politely decline. Why? Because dealerships often mark up the price of gap insurance by 2, 3, or even 400%. They might charge you $700, $800, even $900 for a policy that you can get from your own auto insurance company for a fraction of the cost. Call your insurance agent and ask them to add gap coverage to your policy. It's often as little as $5 or $6 a month. It is one of the easiest ways to save hundreds of dollars right at the start. Okay, so we've plugged the single biggest financial hole for new car owners. Now let's talk about some other optional coverages that add a ton of value and convenience. Think of these as the quality of life upgrades for your policy. Let's start with roadside assistance. You're driving home late at night, and your tire goes flat. Or you accidentally leave your lights on, and your battery is dead. Or, in a moment we've all had, you lock your keys in the car. Without roadside assistance, you're stuck. You're frantically searching on your phone for a local tow truck, wondering how much this is going to cost you. Stressful, and it can be expensive. A single tow can easily cost over $100. Roadside assistance coverage is your safety net for these moments. For just a few dollars a month, you get access to a 24/7 service that can handle things like towing to the nearest repair shop, jump-starting a dead battery, changing a flat tire, delivering a few gallons of gas if you run out, or getting a locksmith to help you when you're locked out. Now you might be thinking, what about AAA? That's a great question. AAA is a fantastic service. The main difference is how you pay and how it's treated. AAA is a separate membership fee, often around $60 to $100 a year for a basic plan. Adding roadside assistance to your auto insurance is usually much cheaper. However, and this is important, some insurance companies might consider a call to their roadside service as a claim. While it won't impact your rates like an at-fault accident, having too many in a short period could potentially flag your account. With AAA, you can use it as much as you need without it ever touching your insurance record. My advice? If you're on a tight budget, adding it to your insurance is a cheap and effective safety net. If you can afford it and drive an older car or travel a lot, a separate service like AAA might offer more peace of mind. Next up on our list of smart add-ons is rental reimbursement, also known as rental car coverage. This one is simple but incredibly important. If you get into a covered accident and your car needs to be in the shop for repairs, how are you going to get to work? To school? To the grocery store? Life doesn't stop just because your car does. Rental reimbursement coverage pays for a rental car while yours is being fixed. Without it, you're paying for that rental completely out of your own pocket. And at $40, $50, or $60 a day, that adds up fast. A simple fender bender could have your car in the shop for a week. That's $350 you weren't planning on spending. More serious repairs could take weeks. When you add this coverage, you'll choose a daily limit and a total limit. For example, you might see something like 30 of 900. This means the policy will pay up to $30 per day for a rental car, for a maximum of 30 days or a total of $900, whichever comes first. For most people, a $30 or $40 a day limit is enough to get a basic compact car. If you have a big family and need an SUV or a minivan, you might want to opt for a higher daily limit, like $50 or $60. It's a small price to pay for ensuring your life isn't completely disrupted after an accident. Finally, there's one more optional coverage that's crucial for a specific type of car owner. Are you planning on upgrading your car? I'm talking about new wheels and tires, a killer sound system, a custom paint job, or a new exhaust. If you are, you need to know about custom parts and equipment coverage, or CPE. Here's the deal. Your standard comprehensive and collision policy is designed to cover the car as it came from the factory. Most policies include a very small token amount for custom parts, maybe $1,000 if you're lucky. So if you spend $5,000 on a professional sound system and custom rims, and then your car gets stolen, your insurance is only going to give you that base $1,000 for all your upgrades. You would be out $4,000 instantly. CPE coverage lets you increase that limit. You can buy an extra $5,000, $10,000, or even $15,000 in coverage specifically for your aftermarket parts. If you've invested your hard-earned money into making your car your own, this coverage ensures that your investment is actually protected. It's the only way to make sure that if the worst happens, you get paid for the car you actually had, not just the one that rolled off the assembly line. So we've covered the secret weapons: GAP to save you from being underwater, roadside assistance for peace of mind, rental reimbursement to keep you moving, and custom parts coverage to protect your passion projects. These are the coverages that truly tailor a policy to your life. We've built our perfect insurance shield piece by piece. We have our liability, our medical, our uninsured motorist, and our physical damage coverages. But how strong is that shield? How much of a hit can it take before you have to start paying out of your own pocket? That's determined by two critical numbers that can either save you a fortune or cost you a fortune: your deductibles and your limits. And in the next part, we're going to demystify those numbers completely and show you how to choose the ones that are perfect for you. Okay, let's break this down. Think of your insurance policy like a financial superhero that comes to the rescue after an accident. But this superhero has two very specific rules about how it operates. Those rules are your deductible and your limits. Get them wrong and your hero might as well stay home. First, let's talk about the deductible. The simplest way to think about it is this: it's your share of the bill. It's the amount of money you have to pay out of your own pocket for a covered claim before the insurance company pays a single dollar. If you have a $1,000 deductible, and you cause an accident that results in a $4,000 repair bill for your car, you pay the first $1,000. Your insurance company then picks up the remaining $3,000. If the damage is only $800, you're paying the entire bill yourself. Your insurance doesn't get involved because the cost is less than your deductible. Now, here's the crucial trade-off: the fundamental seesaw of auto insurance costs. A higher deductible almost always means a lower monthly or yearly premium. A lower deductible means a higher premium. When you choose a high deductible, say $2,000, you're essentially telling the insurance company, Don't worry about the small stuff. I can handle a $2,000 hit. I only need you for a real catastrophe. The insurance company loves this. It means they'll have to pay out less often, so they reward you with a lower price. On the other hand, if you choose a low deductible like $250, you're saying, look, I need help with almost any expense. I can't afford a big surprise bill. This makes you a higher risk for the insurance company because they're more likely to have to pay out on a claim. To compensate for that extra risk, they charge you a higher premium. So which one should you choose? The temptation is to crank that deductible way up to get the lowest possible monthly payment. Feels like a win, but this is one of the most dangerous financial traps a new car owner can fall into. You have to ask yourself one brutally honest question. If I got into an accident today, could I write a check for my deductible amount without breaking a sweat? This leads us to what I call the golden rule of deductibles. Never, ever choose a deductible that is higher than the amount of money you have readily available in your emergency fund. If you have $500 saved for emergencies, don't you dare pick a $1,000 deductible, because if you get into an accident, you'll be scrambling to borrow money or go into credit card debt just to get your car back on the road. You'll have turned a car problem into a major financial crisis. The small amount you saved on your premium will be completely wiped out by the stress and interest payments. A $500 or $1,000 deductible is standard for most people, but it has to be a number you are genuinely 100% comfortable paying on a moment's notice. So that's the deductible. It's the floor. It's the barrier to entry for your insurance to kick in. Now let's talk about the other number, which is arguably even more important, your limits. If the deductible is the floor, the limit is the ceiling. It is the absolute maximum amount of money your insurance company will pay for a single claim. And if you get this wrong, the consequences can be life-altering. When you look at a quote, you'll see your liability limits written as a series of 3 numbers, like 25/50/25 or 100/300/100. It looks like code, but it's simple once you break it down. Let's use 100/300/100 as our example. The first number, 100, stands for $100,000. This is the maximum your insurance will pay for bodily injury to a single person you injure in an accident you cause. The second number, 300, is $300,000. This is the maximum your insurance will pay for bodily injury for all people combined in a single accident you cause. The third number, 100, is $100,000. This is the maximum your insurance will pay for property damage you cause in an accident. This means damage to other people's cars, but also mailboxes, fences, or even buildings. Now, every state has a legally required minimum amount of liability coverage you must carry. In some states, it's shockingly low, something like 25/50/25. And insurance companies will happily sell you a policy with just the state minimums because it will have the cheapest possible price tag. This is the single biggest mistake you can make. Buying state minimum insurance is like trying to protect yourself from a hurricane with a cocktail umbrella. It is functionally useless in a serious accident. Let me paint you a picture. Let's say you have that 25/50/25 state minimum policy to save a few bucks. You're driving on the highway, you look down at your phone for just a second, and you slam into the back of a brand new Audi. The Audi is pushed into the car in front of it, a minivan carrying a family of 4. Let's do the math. The Audi is easily a $60,000 car. It's totaled. Your property damage limit is $25,000. The insurance company writes a check for $25,000 and then wishes you the best of luck. You are now personally legally on the hook for the remaining $35,000 for that car. But it gets worse. The driver of the Audi has a broken wrist and a concussion. His medical bills plus time off work come to $40,000. Your bodily injury limit per person is $25,000. Your insurance pays that. You are now personally being sued for the other $15,000. In the minivan, one of the parents has a serious back injury requiring surgery. The total medical cost is $150,000. Your policy's per person limit is $25,000. And even worse, your total per accident limit for injuries is only $50,000. The insurance company will pay $25,000 for the Audi driver and $25,000 towards the parent's back surgery. That's it. The policy is maxed out. You are now facing a lawsuit for the remaining $125,000, not to mention the injuries to the other people in the minivan. In the span of 5 seconds, by trying to save maybe $20 a month, you have found yourself personally responsible for over $175,000. That's not a bill. That's a debt that will follow you for decades. They can garnish your wages, seize your assets, and financially cripple your future before it has even begun. This is why choosing your limits is not about meeting the legal minimum. It's about protecting your entire financial life. The recommended minimum for any responsible driver is 100/300/100. If you can afford it, 250/500/100 is even better. And here's the secret. The price difference between a disastrous state minimum policy and a genuinely protective 100/300/100 policy is usually not that much. It might be the cost of a few coffees or a Netflix subscription per month. It is the single best value for your money in the entire world of insurance. So here's the strategy. You balance these two numbers. You choose a deductible that you know you can afford to pay tomorrow from your emergency fund. Maybe that's $500, maybe it's $1,000. Then, you take the money you might be saving from that slightly higher deductible, and you pour it into buying the highest liability limits you can comfortably afford. You are protecting yourself from the small, manageable bumps with your savings, and you are using your insurance for its true purpose. To protect you from the catastrophic, life-ruining event that could happen to anyone. We've now built the core of your policy. We've chosen our coverage types, and we've figured out the critical balance between our deductibles and our limits. We've built a financial fortress to protect our first car and, more importantly, our future. But our work isn't done. Inside this fortress are secret passages and hidden levers that can dramatically lower the cost without removing a single brick of protection. I'm talking about the discounts, the driving programs, and the little-known rating factors that insurance companies use to calculate your final price. And in the final part of this series, we are going to expose every single one of them, giving you the ultimate checklist to ensure you are paying the absolute lowest price for the absolute best coverage. Alright, let's pull back the curtain. The price you are quoted for car insurance isn't some random number pulled from a hat. It's the result of a complex, cold-hearted algorithm that analyzes you, your car, and your life, all to predict one thing: how likely you are to cost the insurance company money. Understanding these factors is not just interesting. It is the key to systematically dismantling their pricing structure and reassembling it in your favor. This is your ultimate checklist. First, let's cover the big, obvious ones that you probably already know. Your car itself. The make, model, and year are huge. A brand new sports car is going to cost a fortune to insure compared to a 10-year-old reliable sedan. Why? Because it's more expensive to repair or replace, and let's be honest, it's more likely to be driven in a spirited manner. But it goes deeper. They look at safety ratings. Does your car have a 5-star crash test rating? Does it have anti-lock brakes, airbags, electronic stability control? These things aren't just for your safety. They're discounts waiting to be claimed. Same goes for anti-theft devices. A simple alarm or an engine immobilizer tells the insurer their risk of paying out for a stolen vehicle just went down, and your premium should too. Next up, your driving record. This is the low-hanging fruit. Speeding tickets, at-fault accidents, DUIs. These are giant red flags. To an insurer, your past behavior is the best predictor of your future behavior. If you've proven you're a risky driver, they will charge you a risk-based price, and it will be painfully high. For a first-time driver, you have a clean slate. Your mission is to keep it that way. One speeding ticket can raise your rates by 20 to 30% for 3 to 5 years. Do the math. That one moment of impatience could cost you thousands of dollars over time. And of course, there's your location. Your zip code is one of the most powerful factors in your insurance rate. If you live in a dense urban area with high rates of traffic, vandalism, and theft, your premium will be significantly higher than if you live in a quiet, rural town. They analyze hyperlocal data, the number of claims filed in your neighborhood, the weather patterns, even the quality of the roads. You can't do much to change this factor short of moving, but it's crucial to understand why a quote can change so dramatically just by moving a few miles down the road. Now let's get into the factors they don't exactly advertise on their commercials. These are the secrets that can make or break your insurance budget. The number one hidden factor? Your credit score. Yes, you heard that right. In almost every state, insurers use a credit-based insurance score to help determine your premium. Their logic, based on mountains of data, is that people who are responsible with their finances are also more likely to be responsible drivers. It's controversial, but it's the reality. A person with excellent credit can pay literally half as much for the exact same coverage as someone with poor credit, even if they have identical driving records. So what's the move? Pay your bills on time, keep your credit card balances low, and check your credit report for errors. Improving your credit score is one of the single most effective long-term strategies for lowering your insurance costs. Next, the personal stuff: your age, gender, and marital status. The data is unflinching. Young drivers, particularly males under the age of 25, are statistically involved in far more accidents than any other group. As a result, they face the highest premiums. There is no way around this, but it does get better. Your rates will typically start to drop significantly once you turn 25, assuming you keep your record clean. Being married can also drop your rates. Insurers see married individuals as more stable and less risky, which translates to a marital discount. Here's another one most people miss: your education and occupation. Data shows that people with higher levels of education and those in certain professions, like scientists, teachers, and engineers, tend to file fewer claims. Insurers see these as signs of a lower-risk lifestyle. Don't lie about your job, but be specific. An editor might get a better rate than a writer, and an analyst might be cheaper than a consultant. When you're getting quotes, ask the agent if tweaking your job title while still being truthful could impact your rate. Finally, there's your coverage history and your annual mileage. How much you drive is a direct measure of your exposure to risk. If you have a 5-mile commute, you should be paying less than someone with a 50-mile commute. Be honest about your mileage, but be accurate. Don't just guess. And never ever have a lapse in coverage. Even a few days without insurance can label you as a high-risk client and cause your rates to skyrocket when you try to get a new policy. It's a signal to them that you are not responsible, and they will price you accordingly. So now you know the factors. How do you turn this knowledge into cold, hard cash in your pocket? You go on a discount hunt. You are now an informed consumer, and you need to ask for every single discount you are entitled to. This is your action plan. First, the good student discount. If you are in high school or college and have a B average or a 3.0 GPA, this is a must. It can save you up to 25%. Get a copy of your transcript ready. Second, take a defensive driving course. These are often available online, take a few hours, and can provide a discount that lasts for 3 years. The small cost of the course will pay for itself many times over. Third, when you get a quote, explicitly list every single safety and anti-theft feature on your car. Don't assume they know. List the airbags, the anti-lock brakes, the daytime running lights, the alarm system. Every checkmark is a potential discount. Fourth, ask about payment discounts. Can you get a lower rate by paying for the full 6 or 12-month policy up front instead of monthly? Almost always the answer is yes. Can you get another small discount for signing up for autopay or for going paperless? Yes. These seem small, but they add up. Fifth, think about your affiliations. Are you part of an alumni association, a professional organization, a fraternity or sorority, or the military? Many large groups have partnerships with insurance companies that offer their members exclusive rates. And the biggest discount of them all, bundling. If you have renter's insurance, or if your parents have homeowner's insurance with a company, get a quote from that same company to bundle your auto policy. The bundling discount is often the largest one they offer, sometimes saving you 15% or more on both policies. Your final mission is to take this checklist, get at least 5 different quotes from a mix of national brands and smaller local insurers, and put them head to head. Don't just fill out the online form. Pick up the phone. Talk to an agent. Walk them through your checklist. Ask them directly, "I have a quote from a competitor for this price. Can you beat it?" And before you hang up, ask the golden question: are there any other discounts available that I haven't asked about? You would be shocked at how often they find one more. Remember, your insurance policy isn't a one-time decision. It's a living document. You should reevaluate and reshop your insurance every single year, especially around your renewal date. Did your credit score go up? Did you turn 25? Did you get married? Did you move? Any of these life changes are a reason to shop around, because the company that was cheapest for you last year may not be the cheapest for you this year. We started this journey to demystify the confusing world of auto insurance. You learned about liability, collision, and comprehensive. You mastered deductibles and coverage limits. And now you have the ultimate insider's checklist to not just buy insurance, but to get the absolute best deal possible. You are no longer just a driver. You are an educated consumer, armed with the knowledge to save yourself hundreds, if not thousands of dollars. You are in control. If this series helped you, if it gave you the confidence to navigate this process and get on the road, then our mission is accomplished. Hit that subscribe button, because we're dedicated to giving you the knowledge to master every part of your financial life. And share this series with anyone you know who's about to buy their first car. It might be the most valuable gift you can give them. Drive safe, drive smart, and never ever overpay.